One of the early lessons I got in pattern recognition in investing was believing more in the second and third act than I think really would transpire for most companies. So I would invest in a non-founder-led company. You point out Satya. I know dozens of incredible CEOs that were not founders and have same but different mix of special sauce that makes them the right person to lead that company, and often to lead the company through different stages.
Ready to go? Laela, I am so excited for this. I can't actually remember the last time we did this, but it was like years and years ago. So first, thank you so much for putting up with me for a second time.
Harry, I'm so happy to be back. It has been too long, but it is great to see you.
Venture is always categorized as this pattern recognition business. And to some extent, I agree. And to some extent, I wildly disagree. And I'd love to hear your thoughts. How do you think about whether this is a pattern recognition business versus when it should be disregarded and we should see the Daniel Dines and go, you're a slight anomaly? How do you think about that?
Pattern recognition is certainly important in this business. And I think that I look at my own career and as I've been able to see more businesses, both as an investor, and then I spent many years as an operator. So I think I developed some of my deepest pattern recognition from the years that I spent operating and building teams. So I certainly think it is important. And I think to some of my earliest investments, like I led the Series B in Gusto. That was one of my first investments more than 10 years ago. And the pattern recognition there was that I had spent many years as an operator building SMB businesses. So I knew just how hard it was. I wasn't somebody that you could just give a pitch to about how you could scale this and that because the TAM was so large. I knew that the nitty gritty was in the operating details of how you scale channels and what the marginal CACs were and what the devil was in the details. So I don't know if that's pattern recognition or an insight, but I think some of the best investors, that's what they have. They have insights across industries that they bring together to make the right type of bets and lean into the right type of risk. So I think of that more as even more important than pattern recognition.
Do you think those insights have a shorter life than ever before today, given the fast-moving nature of our business? AI has changed so much of it. It will continue to change so much of it. PLG has changed in many ways. It is moving so much faster than it has ever moved. To what extent does insights decay?
I think insights will always be important, but if you rely entirely on insights, entirely on the past predicting the future, you'll never be a great investor. I think it's the combination of insights with an open mind. So the first time that I invested in Stripe back in 2017, it was that same insight around understanding S&B scale. As you know, Stripe's early customers were inception customers. They were startups getting off the ground. And the new learning had to be, how do you think about an SMB channel expanding into enterprise sales, and what will be different about a developer-led sales motion compared to a decision maker led sales motion, and what would look differently. The AI example that you bring up today, I think we're looking at the same things, which is enterprise AI customers. You're still in the existing world, you have companies that are going to buy software or buy AI, but you may have to think differently about their pace of adoption or the risk to their core business. So everyone thinks that time is different. This is faster. This is going to, it's going to break sooner. This is a bigger trend, which I think to some extent is true. But the core in taking the important insights from the past, taking the important insights across industries, and then be willing to see something new. To me, it's that combination that makes a great investment decision.
When did you rely on the past, and you did rely on it, and it damaged you in doing so?
Early lessons I got in pattern recognition in investing was believing more in the second and third act than I think really would transpire for most companies. So I'll give you an example. Again, when first did the Stripe investment or the Credit Karma investment. Both of those are examples of companies that have really, really strong core businesses in totally different areas. But they also have compelling stories for all of the additional software and additional products that can come along with it. And those are examples of companies where their core businesses were so strong that you didn't even need to see the second and third acts early on in the evolution, because the first lesson is fantastic markets are always way bigger than you expect. But we had many other companies where the core investment, the markets were not as big, and you really did need to see the second or third act transpire in order to make it a great investment. And I really learned that that is much harder than it seems to do. And it takes much longer. The chance of success once you've seen a large number of growth stage companies, you realize is relatively low. So the example I can think of is now when I look at an investment, almost always my base case is I'm only going to underwrite what exists today. I can get excited about the possibility of the future, and that's built into the upside case. But if there's not evidence of the launch of that product or any sort of insight around consumer buying, real data driven, then I will not put it in the underwriting base case. And I've missed a few great investments for that. There are a few teams that really can launch products at a speed that is just, the velocity is unmatched in the market. They have the right intuition, and they really can create multiple product lines and multiple business lines. They are the exception. But using that as an example, as a pattern recognition, I can lose my base case on price based on the rigidity of that underwriting framework.
Let's dig into that. I can lose my base case on price. And so you need to see the one core app being the dominant thing. And it's great that we have all these other things, but we need the core. Great. And so you're not willing to pay up as much as other people are who see the ancillary products as an eventual outcome?
Yep, that's exactly right. At times, and there's been times that, I have broken that rule. And there are times that great companies show you the evidence of that right away. I'll give you a good example of that. So Whatnot, which is a investment that I led a couple of years ago. I'm still on the board there. They're in the live commerce space. And we had been tracking that space for a long time, really believed that there was a huge opportunity in live shopping to not only build a live shopping business in the US, but and globally, but to use live shopping as a wedge to displace some of these older network effect businesses in categories like collectibles, where it's really hard to dislodge the networks in those spaces. So I'd been tracking a bunch of early stage companies in that space and really believed that the right approach was a multi-category approach. Met with most of the founders, and understandably, in a network effect business, it makes a lot of sense to start in one category and build up the network, and it's hard to go multi-category at once. Met with several founders who their plan was to go multi-category, met with a Whatnot team, and I met with them within 4 or 5 months of their Series A. They were already live in 5 categories. So you saw evidence, even if it wasn't, to liquidity yet, or didn't have the dimensions of a full launch. You saw evidence that they were executing a multi-category strategy. So whenever I'm underwriting a case that involves expansion beyond the core and what you're seeing, I look for any evidence, and I'm creative. It doesn't have to be working yet. But you want to see some something that's a little bit of an outlier that shows you this team is different. This team can execute multiple things at once, or multiple things faster than the average, because the reality that you see in most startups around this second act is that they talk about it in board meetings, have it on their plan for a long time. Hey, we're going to go international. It's pushed out a bit. We're going to launch this product. It's pushed out a bit because it's so hard. There's so many things you're doing to focus on the core. And there's so many things just to have the opportunity in front of you. But that is an example of a bet that more often is wrong. Believing that companies can achieve that sort of second act or that expansion. And so I look for any evidence to show that there's an outlier, and at times we'll make the bet without it, or times try to creatively convince myself through data that there's evidence that this company has a chance to do it more than others do.
In general, do companies wait too long and do it too late, or do they do it too early and lose focus?
So I'm a growth stage investor, so I would say that probably varies a bit based on time. I would say in the growth stage, more often they wait too long, particularly as they're ramping up in the couple of years prior to IPO, because it's almost always needed for a strong public company to have some sort of diversification. And again, some sort of evidence that you're going to have durable growth over time. And that usually requires expanding your market in some way or deepening your relationship through additional product offerings with your core customer. And more often than not, those founders believe they're a couple years behind where they would like to be in proving to themselves that this story is true and that this is the right investment. And then, proving to public market investors that these really are going to be durable revenue streams.
Do you find early stage investors help in that messaging to founders in terms of the advice they give them? I'm on the board today, and most of my advice, honestly, would be contra what we said there. It's like focus, make sure we have customers that love us, and only then do we expand when we have significance, when we have reliability, repeatability, and at scale. And always your core market is so much bigger than you often think. I think HubSpot is a great example of that. Do you think early stage board members make that case more challenging for you, preventing multi-product expansion?
No, I think it's really a timing issue. I trust that is the right advice for early stage companies. And I think the best companies we've invested in have followed that advice, and they have stayed extraordinarily focused. They've nailed it in their core market. So this is more really advice for the growth stage companies where, you get to a certain scale, you're at 100, 200 million in revenue, a private company. By that point, you're investing a significant amount of capital in operating expenses and R&D and sales and marketing across the board. So you're starting to, and you typically have a large team. You have hundreds of people, sometimes more than that. By that point, you're operating with a complexity where you do have the ability to execute against multiple priorities. If you don't, you're probably going to have more trouble in the longer term. So I think the same advice holds. You stay focused on your core business. You make sure you optimize, and some have more opportunity for scale than others. Like again, if we talk about the examples of the Stripes of the world, their core business is so large that and so complex that there's going to be a significant amount of investment in that core business for a long period of time. But you also get to the stage where you have the opportunity to invest in adjacent areas and expansion opportunities. And the mistake I typically see companies doing at that stage, the growth stage, is too much, not making concentrated enough bets in the second, third act. And they're not significant enough, they're not focused enough, they're not large enough to really to make a meaningful impact on the core business and to make a meaningful investment to again be large future revenue streams. So I think the actual same advice holds. You need innovation at that stage. You need focus. You need prioritization, but you have to be able to do it within your core as well as the second and third act. And that's what I see as a common challenge in growth stage companies.
What was the most prescient failed second act to you, and what did you learn from it?
I think the common errors are not enough, having a ton of success in your core business, which is hard enough. So you get to this point as a startup and a startup founder, you're like, wow, we've done the impossible, right? We were this scrappy little company, and now we're a big, meaningful share gainer in this important market. And they almost make the same mistakes that the incumbents that they beat in their first act are making. Don't fully appreciate how hard it is to win share in that adjacent market. They don't think hard enough about right to win. The easy cases are where right to win are around sort of you already have the distribution and it's a logical extension. But I think some companies overestimate that. So I've seen lots of companies sort of launch second acts in markets where again their product isn't competitive and they can't get the share that they expect and that they got in their first they got in their first core market. So I think a lot of it is just about the same thing that incumbents tend to do: underestimation, really thinking hard about the right to win and why their product is differentiated, and then focus and resources. So not being focused or resourcing the effort well enough to truly win.
You can't blame me for trying.
I know. Good try.
Credit to me.
Jerry, you're like a pro at this these days. I see, all the you know how to get the squeak in there and get all the questions for the answers that you want.
But you mentioned about 100 million in revenue there. I have Bill Gurley and Brad Gersner saying, oh, people should go public at 100 million in revenue, and they can. And then everyone else says, no, you can't really. It's more like 400 to 500 million. How do you feel about, can you go public at 100 million in revenue, or is it actually much more?
I think that the sort of biggest challenge I see in a lot of companies making the transition from private to public is really around predictability. It's how they're much more typically, especially in the environment we've been in for the last decade as private tech companies. The rewards have gone to founders that have been ambitious, think big, try to grow as quickly as possible. Obviously, we've seen a correction and a move towards profitability along with growth the last 2 years. But there's there's a premium for just like dream big, execute well, and get approximately there. That's different in the public markets. In the public markets, you really need to say what you're going to do and then do it. And the companies that are rewarded in the public markets are able to tell their story well about why this is an important market, why they're a big and impressive company, how they're going to continue to grow, how they're going to deliver profitability and returns to shareholders, and they need to do what they say they're going to do. And that's a different discipline. And I believe if you do that, if you tell your story well and you execute how you tell investors and the public markets on how you're going to invest, you actually have high degrees of freedom to invest in the things you want to invest in. I think there's a bit of a myth that once you go public, you can't make the investments that you want. I don't believe that's true. I think you can make the investments you want, but you are accountable to delivering those results. And when you don't deliver those results, you go into the penalty box. And the penalty box can be a more constraining place to operate. So I think that's where some of, in my view, sort of the fear and the myths and the realities of the public market stories stem from. But I don't actually think it's necessarily a scale thing. I've seen $100 million revenue companies that are operating with that level of precision, have their story tight, have their execution plan really tight, and would be a good candidate to go public and could reap a lot of the advantages of that access to capital and some of the other things we talked about. And then I've seen other companies that are above 500 million in revenue and are operating without that level of discipline, or where it would be quite a hard transition, I think, to get into that sort of quarterly reporting cadence. And they need to make investments in order to do so.
I'm going to make you feel incredibly uncomfortable here, but
yes.
Why not? Fuck it. Stripe. Yeah, and this private capital markets means that they don't need to go public. You don't need to comment. I'll put a strong bet on that they won't for many years. I don't think John or Patrick want to go public, and I don't blame them for not wanting to go public. My question to you is, this business has an inflow and an outflow, and the outflow's been turned off. Like, Wiz doesn't sell to Google. Again, you're not commenting, obviously. But it's like, of course it would get blocked. So of course they say no. But then do you want to wait for an IPO? Like 18 months, lock up, get shit from public markets investors. How do we solve the problem of liquidity, Laela?
So first of all, I think that the IPO markets will open back up. And
when?
Gosh, we don't, who knows that? But I think they will open back up. And when they open back up, I think you're going to see a ton of great companies go public. And I think, you asked a question about M&A. I think, at CapitalG, at least, what we're focused on when we make growth stage investments is we really believe in founders and companies being able to control their own destinies. So we look at opportunities and say, could this be a standalone public company? And we would never underwrite something dependent on M&A. Although, as you say, M&A historically in tech has been a wonderful exit for a lot of investors and a great place to land for companies and founders. Multiple paths are always great when you're leading any organization to consider them, but we're always looking for the standalone, control your own destiny. And in almost all cases, that means being a public company at some time. And that's what we look for.
We had Dalian on the show, and he said about the best companies are always founder-led companies. very kind of seriously. And I said, well, Satya Nadella, and I pushed back in that way. And the great leadership that Microsoft had under Satya. I'm intrigued. Would you invest in ever a non-founder-led company? And given the founder-led focus, is early stage really that different to growth stage?
So I would invest in a non-founder-led company. You point out Satya. I know, dozens of incredible CEOs that were not founders and have same but different mix of special sauce that makes them the right person to lead that company, and often to lead the company through different stages. Some founders only want to do the early stage nature of the companies, and their genius really is in the more entrepreneurial pursuits, and they want to bring in a partner that has more strengths in scaling or large company building. And I think you get a different set of trade-offs for that. I think there are examples that we could point to in so many different areas where both can be true, but you often, they're real trade-offs. And I think we try to support founders to scale into the best CEOs that they can be as their company scales for as long as they want to, and believe and have seen it been extraordinarily successful across a bunch of companies.
When they don't scale, why don't they scale?
A wide variety of reasons. I think sometimes it just comes down to, I'm a big believer that you have to really love and want to be doing what you're doing to be the best in your field. And I think sometimes it's just a match for personal passions, and some people just like to build 0 to 1 more than they want to build 1 to 100. They like or dislike the people management and the team complexity side of things. And then then I think there are just some attributes around running a larger scaled company that are important. Some operational skills, it's a better match to bring someone else in. But I think typically, and almost always, we've seen in our portfolio that even when a founder doesn't have those skills, he or she has extraordinary talent, again, and passion and drive that got them to that point, and they can hire in the right executive team to build out. The team needs those skills. No one person ever needs a particular experience set or particular skills. That's why company building is a team sport. It's not an individual sport.
Do you think so? Because we had Matt Clifford from EF on the show, who's like Entrepreneur First, the second largest, I guess, incubator compared to Y Combinator. And he said that for founding teams, what matters most from 10 years of people evaluation is actually the spikiest skill of one founder, not the balance of the team. That is the single biggest determinant. I
would say there's a difference for the 0 to 1 versus the scaling a company on that particular insight. So I could see how that is stronger when you really just need to get to product market fit. There's something that, and I do think outsized genius in that area. And I'm a big believer in spikiness. I mean, that's one of my core investment theses, is always look for outlier metrics and look for outlier personality traits in a founder. I believe that outlier data is really important to pay attention to, and that will end up having outsized impact and returns. So there's a large part of that I agree with. But I think as you scale to a larger company, huge scale, customer base, complexity of products, complexity of size of organization, it absolutely is a team sport. You can no longer just rely on that one outlier or that extreme outlier advantages or skills or gifts that founder has. Sure, those continue to contribute in an outsized way to the company's success, but it will never be enough alone to compete on a field where you're playing against other teams. You're not playing a one-on-one game. So I think that just a transition that companies have to make as they go from success, early product market fit, to real significance and large scale impact.
What happens to the generation of companies now that is between 30 and 100 million in revenue, but they're growing like 15 to 30%, maybe 40%? What happens to them?
I think that's going to be a very interesting investment opportunity and a good question. I mean, I do think that there are that group of companies probably are operating in smaller markets than maybe everyone anticipated when they started the company, and as they've grown, if you see companies growing at that rate, at that scale, it's usually either a signal that the market size is not going to be big enough to build a $500 million, billion-dollar business, or there could be some element of their growth. It could be a vertical marketplace or a vertical software company where, it's a slower growth, but as you add the R&D capabilities, you can, increase share of wallet and add product modules. So you can see some companies that, when they reach 100 million in scale, they continue to compound at 15 or 20%. But most of the time, you see a decay curve. So most of the time, if you're growing 15, 20%, you'll see that decay to single digits. And I do think that those companies, it's going to be hard to remain independent. I do think many of them that I see in the market are trying to first figure out how to be sustainable. So figure out at that scale, can they reach profitability or, single digits profitability? But that's obviously going to be a tough public market case, a tough case to sort of return invested capital. So I think there's a lot of creative conversations happening about that set of companies. Can they be combined into a bigger entity and try and figure out scale? Is there a model where they could be much more profitable? Because if you're 100 million, but you can get to, 20, 30% EBITDA margins, then that's a whole different financial profile. So I think that's going to be a really important question. And there are dozens and dozens of companies in that category that have been well funded. Some of them still have a significant amount of capital on their balance sheets. So they're trying to figure out if they can invest to try to reaccelerate growth. And I think you'll see a range of outcomes. And there'll be some good investment opportunities in that.
Do you have the financial freedom to do roll-up plays? Like, are you structured in a way where you could actually kind of cross PE as well? Everyone is talking about roll-ups today, especially if you are in beauty, spas, or vet services, by the way. That's the hottest. But is that something that you could do in the structure? So
in the context of working with a private equity partner, if they were to do a roll-up or invest in more traditional profitable assets that either trade from the public markets to the private or have been private the entire time, then we're very open to partnering with those companies, and we'll write we typically write $150 million check into a larger buyout that those firms are doing. And we have had a lot of success with those partnerships. So we do it in that capacity. We wouldn't, we haven't, I should say, we never say never, but we haven't done a roll up on our own accord so far in our history.
You're like, Jesus, Harry, I remember years ago, these were softball interviews. What the fuck happened to your show?
You're getting good, Harry. I like it.
I told you, it's age. I had Sam on from Greylock, and he was like, Series B and C, these vintages won't make money. Mm-hmm. And you're seeing Pat Grady move earlier, do Harvey at seed, which looks like a pretty prescient investment, to be honest. How do you think about that when you hear Series B and C entry prices being where they are, often 400 to $1 billion? It's going to be a tough time.
So first of all, I never listen to the summaries of the market from any industry insiders or any of the other firms because I've never found generalizations to be great. And we have always found great companies to back during every single point of all of the cycles. Some points it's been harder or easier, but there are always great companies to be bought and invested in at fair prices. You don't always know they're fair at the time, but when you look back, if you made the call right, they're very fair.
Which price when you paid it felt most unfair, but now looks most fair?
I mean, the way that you think of fair in growth, I mean, it's a funny word, so I'll define it a bit, is, you look at the valuation multiples and you take a set of comps and you have obviously public market comps, and then you have all the private market comps. So there are stages of the market that the multiples that you're paying are extraordinarily high, and they don't make sense from historical averages, and they don't make sense, sometimes compared to the public markets, depending on the cycle. So it's all that's probably the most objective way to define fair is just how does the multiple vary based on comps. But the part of the equation that's hard to figure out is the part that you have to analyze as an investor is, what do you believe the future growth prospects of this company are? And if you're more bullish that it can grow faster or better or different than other companies in the comp set, then you are in fact paying a fair price. So, we can pick the big winners. Like I'll go with Stripe, 2017, when we invested in them. Nobody, or I would say lots of people, didn't believe that they could compound and continue to grow at such a strong rate that actually the valuation multiple that we were paying into was more than fair, because they would compound in such a large market and expand into, other adjacent markets, and could be a much, much bigger company than perhaps, you imagined at that time. So that's the part that is the judgment part of this. And of course, the risky thing in venture is that it's easy to assume that all of these companies are special flowers that will compound at extraordinarily high rates deep into the future. And of course, most of them don't. So those in retrospect end up looking like less good valuations if you paid up for future growth. But there will always be the outliers that you couldn't imagine that they would grow as robustly and as well as they've done. And, our job is trying to pick those. And then our other job that I would say is, it's been interesting to me, sort of seeing how different parts of the industry go risk on and risk off. But I would say, 2023 for us was as an example, was a great year. We did, I think, a lot of really great investments. And when a lot of the market was pulled back, you're starting to see people lean in more now. But I think there are a lot of great investments across all the stages. We've gone earlier as well, especially in industries like AI, but we're seeing opportunities across the board.
Are people really leaning in more now? Like, it feels like seed never adjusted. Seed pricing never adjusted. Volume maybe adjusted a little bit, but pricing definitely didn't adjust. But everyone is in unison that growth is dead, which is a bit of a morbid statement, obviously. Do you disagree? And do you say that growth isn't dead at all?
Yeah, I don't think growth is dead. I think it depends how you define
volume and activity.
Yeah, I mean, volume and activity is definitely down from the peak 2020, 21 for sure. If you exclude the AI deals, that if you add in AI deals, the volume and dollar amount actually looks quite high. So definitely volume is down, but that is different from being dead. I think there are still, I started investing in 2014, 2015. Like you see, there are activity levels where there are great companies that are growing quickly and opportunities to invest. And then there's the later stage, and that's early growth, the later stage of sort of pre-IPO companies where I think you're starting to see some interesting rounds where they're not going public because of the macro reasons we've talked about, but they want to raise a little bit of primary capital, and some early stage investors want to sell some secondary capital, and those companies are being priced in line with public comps. So there are some, I think, good investment opportunities in what we believe are going to be, franchise type companies in large markets. So you maybe have to work a little harder than some of the heydays of when we're at a peak market opportunity, or peak market activity. But I think that there are many great investments to be made, and people that operate counter to the generally accepted views in the market are probably going to be the ones that have the most outsized returns.
I remember at peak, one of my portfolio companies was doing like $500,000 in ARR, and one of the best firms in the world did them at 700 million post. I called up the founder and I was like, wow, like 1200x ARR. Welcome to a new record club, baby. That's impressive.
Yeah.
So that was bad. What happens to all those companies that got a shitload of cash and are like, nah?
They're trying to figure it out. I think the hardest first reality check is to figure out if those companies can recruit a team and retain a team that still believes in the dream and are they able to execute and are they able to grow? Like obviously their valuations, many of them are going to be way off what the valuations would be if they were marked in this current cycle. And those that have the ability to grow into the valuation and are continuing to execute both from a financial performance, and then you can feel it. And when you talk to employees and when you talk to the leadership team, and you can really, in my opinion, feel whether the belief is still there and the excitement is still there and the momentum is still there to build something big. And they're eager, and many of them already have caught up to their valuations at peak amounts. And then you see the other set of companies where they raised way above what arguably you could say the company should have been valued at. And when they lose momentum and are not executing, it can be a double whammy in terms of recruiting and retention. And I think those companies are either going to have to, again, figure out what an opportunity is to combine with other businesses, or how else they're going to restart, refresh, whether it is a down round to get the right sort of equity investment, mostly, again, for their employees. Because you need people around the table that believe, like building startups is so hard. It takes so much longer and so much more emotional and other energy than I think anybody expects when they're starting a company. And certainly even when you expect just being a board member or partner or advisor to a CEO, it's really in it for the long haul. And so I think always having that belief is critical.
Were your best deals obvious?
They never felt obvious. I tell this to my the younger members of my team starting out. I'm like, if you feel nervous and like you're advocating for something so hard and others are telling you no, and you know, to the point that it almost makes you doubt it yourself, you're exactly where you should be. You're exactly where you should be.
But like Stripe feels obvious. Like the best cap table, very clearly generational defining founders. That feels obvious at the D.
Well, let me tell you, when I did that deal, I remember talking to lots of other investors, and the pushback would be, it's in a commodity market, it's valued too high, there's not real differentiation. So it's always easy to look, and I, of course, believed the opposite, and did, talk to dozens of customers, spent a ton of time with the team, really understood the cohorts and why this was a differentiated go-to-market strategy that they have. So I believe something very differently. But I won't call out names of many smart investors that sort of believe the obvious or believe the opposite. UiPath, when made that investment in the Series B, the numbers were extraordinary. But the pushback was, this company's been around for 10 years, based in Romania. Like, why is it all of a sudden exploding now? And all the risks that people feel around category creation. Like, really, is RPA going to be that big of a market, or are they going to putter out? So I think there's any good investment has, the counterpoint and the part that is less obvious. And I think the job of us, especially as growth stage investors, it's not just to get conviction in the thesis, but it's to get conviction in the thesis at that price, which does require, for the best companies, because the more obvious it is, the higher the price you're paying. So you have to find deep conviction regardless.
Laela, what do you need to underwrite?
So we underwrite 3 to 5x returns, money on money returns, and depending on the stage.
Okay.
So if it's really early, it will be 10x, but the core of what we do in growth is 3 to 5x money on money returns.
You have one LP. Do you give a shit how long it takes?
Yeah, we do. Of course, but
you don't have the liquidity pressures of having 30 different institutions going, "Where's my money?" And so,
and that's a huge advantage for us, because it means that we can invest and hold over the long term, and why we're so obsessed with finding generational companies that will compound over the long term, because that creates incredible money on money and incredible IRR returns without having a false reason to have to sell companies that we really want to own.
I hold all my companies that go public because I have asymmetric information and I should hold those positions, not my LPs. Do you agree with that statement, or do you disagree that actually just because you're a private investor, you have asymmetric information and you should hold the public stock?
LPs have a lot of different incentives that they're managing, and they have full-time investment professionals, many of them managing their public positions, and public investors tend to have different access to data and insights and decision making that help them decide when is the right time to hold and sell in the broader context of their portfolio. So I could see the case why that could be more important than an early stage investor who has information from when the company was private that they think is going to, inform the right decision to buy or hold when a lot of other things are going on in the public markets. So I have been surprised by some, not you, Harry, because you're particularly talented, but there's a lot of private early stage investors that don't understand a lot of the dynamics of public markets and valuations and pricing and how and portfolio management at that scale. So it's not just about understanding the ins and outs of the company. It's understanding a lot more, have a lot more context into that decision making.
I think we grossly overestimate our own knowledge of companies. Yeah. And the conditions matter a lot. You have short sellers, you have activist hedge funds, you have a huge amount of variables that are not present in private markets. And it's like saying I'm a great tennis player on clay. Great. Yeah. But actually, if you play on a grass court in the rain, it's a different fucking deal.
Totally agree.
I think that's not said enough. So yes. Okay. So liquidity does matter. But you can hold for a long time. So what have been your biggest lessons on when to sell? You very kindly said I was very talented. No, Laela, I fucked up mega on not selling companies that I should have sold.
That's the fun part about our job, Harry, is we got mistakes on the entry, mistakes on the exit, which keeps it interesting and wins on both sides, right? So I think it's it's humbling to know when to sell, right? Because you have, as you said, your own conviction on, which translates by the time this company is public, your conviction should show up in the financials that you're willing to underwrite. So again, we're growth stage investors. We're investing $50 to $200 million in these companies. So we put these are big bets where we have a significant amount of resources on our team to really understand the customers, the company performance, the financial model that we're willing to underwrite. So it first starts with, what are you willing to underwrite? And how much conviction do you have in that? And then the decision to sell is also, of course, impacted by I saw a chart last week that was showing sort of exits in the last 5 to 7 years and showing just how much of it came from multiple expansion, right? So meaning just how much of the returns in the private equity landscape came from exits, companies trading at multiples higher than historical averages, which of course we all know for anyone that exited in 2021 as an example, if you exited there at all, it wasn't just company performance. You were exiting for almost every company, trading at significantly higher than historical averages. So there's an element of timing as well, that you're underwriting the financial performance, and then you have to be prudent when you're managing positions to think about the macro environment and to de-risk in some cases or lean into the risk of your overall portfolio. I don't think if you're talking to an LP, whether it's one or multiple, and you had a large portfolio and you didn't deliver any DPI during sort of 2021, you might have some questions. So I think it's always a balance of how you do it. But we look at holding positions as continuing to buy into the thesis, and we love continuing to buy into the thesis of our very best companies.
What's the largest position you have?
We're not going to go into specifics on any positions. But we're managing $7 billion is how AUM CapitalG right now.
You said about mistakes on entry and exit. Mm-hmm. My biggest mistake on entry was thinking emerging markets was a good idea and investing in Pakistan. What was your biggest mistake on entry, and what did you learn?
We had the global markets. You bring up a very, I think, important point. We started CapitalG from the beginning as a global firm, global investment mandate. But I would say we've also made mistakes in entering markets where we didn't have, a robust set of history or local resources on the ground, particularly those that were serving more local markets where there were more surprises. And that has been, certainly some hard learned lessons along the way.
What did we get wrong there? There weren't people on the ground? In
a lot of places, the way companies scale are quite different. So I'll use India as an example. I mean, you looked at the typical size and number of employees of an Indian tech company, and it was significantly higher than a lot of the US counterparts. Just the operational complexity complexity of running those types of markets, really understand, or those types of businesses, really understanding the consumer landscape and GDP per capita, all of those purchase behaviors, and getting market timing right and getting the overall business models right, I think have been, they're just harder bets, and require sort of a different understanding of the risks you're getting into. And I would argue in some of those markets during the peaky bubble points in the global tech markets, that risk wasn't necessarily priced in on the valuations. So I think you found, in some of the cases, at least on a deal by deal basis that we made, I think there were more mistakes there than areas where we really understood the industry, the locale, the market.
The risk was definitely not priced in. Okay, but you mentioned that feet on the ground, and it just makes me think of like venture value add. You know, Brian Singerman, Founders Fund, very clearly have the thesis that the best founders do not need your help. Do you agree the best founders don't need the VC's help?
The best people in the world can always benefit from having help. Right. I think that the best founders will only be better if they have a really strong board, as an example, or they'll only be better if they have a strong set of advisors, friends, colleagues that they can go to help answer questions quickly, to provide additional resources, to be a sounding board. And we are here to support and be as great of a partner as we can.
Who's the best board member you sit on a board with?
I've sit with lots of great board members. I love Rich Wong at Excel. He and I have been really...
Why is Rich so good?
I think he's incredibly supportive to the founders. He has really great relationships with the executive team. He asks the hard questions. He does the work. He's really insightful and good person.
I'm going to do a quick fire. So I say a short statement. You give me your immediate thoughts. Does that sound okay?
Great.
What do you believe that most around you disbelieve?
Things that irritate you in others are probably things that you have in yourself.
What irritates you?
What irritates me? Entitlement. So I guess I need to look at that, Harry.
Do you think many are entitled to this?
Your quick fire's changed. I think we're all entitled. I think we're all entitled in different ways. Yeah.
No, but I think we have like a generation of incredibly entitled people.
Yes.
Like, it amazes me that I've been able to get so far with such low IQ and just hard work. Like, that is incredible.
That statement, Harry, but I would +1 on how far you can get being humble and scrappy and hardworking.
Which venture investor do you most respect and learn from outside CapitalG? Can't be Rich Wong. Just said it.
I think what Elad Gil has done in the AI space has been really extraordinary. So I always enjoy chatting with him and respect him a lot.
Can you do AI growth today and make money? It is a place where corporates invest, and they are irrational financial investors. NVIDIA, Amazon, you name it. They do not have the same objectives that us investors do. And so it's a different game. Can you make money doing growth AI?
So we believe that over the last 18 months, the best opportunities have been going earlier in these AI companies, and that is what we've done. That being said, the market changes rapidly. So I think there are a really exciting set of, I was just looking at our pipeline actually yesterday afternoon, of growth stage AI investments, and they are scaling at extraordinary rates. There's really interesting technical differentiation, founding teams. So I'm excited about the look forward of investable opportunities in AI, and things change rapidly. So who knows what the strategics or other capital sources will do. So we're always focused on building relationships and tracking the very best companies, and confident that when the valuation is right, we will get in there. But I do agree with you that the previous 18 months, that the AI market has been robust and not always easy to understand the sort of financial return.
I'm sorry for the base question. Google Ventures does Series B, and so does CapitalG. Do you compete?
So we're primarily focused on growth. There are times we go earlier, and there are times that they go a bit later. When that happens, we will collaborate. We'll work together, which we've done in many great companies. But most of the time, we're focused in different areas.
Is it like parents come in and say, play nice, kids? Like,
we are the parents and we're playing nice, Harry. So they're a great team and we love working with them.
Yeah, I love Tom. Tom is one of the nicest guys in venture.
Tom is fantastic. David,
what was the most memorable first founder meeting you've had, Laela? The one where you're like, that one I'll tell the kids about.
Oh my goodness. Well, since you asked that, I will bring up Daniel again, because when you say tell the kids about Daniel, I flew to New York like within weeks of coming back from maternity leave with my third child. I have 3 kids, and chased him down to New York this time. And I remember that first meeting, not only because I was fresh off maternity leave, so I had a lot going on, leaving 3 little kids at home. But I also remember that the majority of the first meeting, we talked about our upbringing, our families, literature, and very little about automation. So that was the first of a very deep relationship, business and personal, on getting to know each other. And I think that is certainly important to me, and I think important to a lot of the founders that I work with, that there's trust, and there is a relationship that is based on really liking each other as people and believing in a common dream, and then trying to help support each other to get there.
Would you ever invest in someone you don't like?
I try not to, Harry.
It's an interesting one though, isn't it? It's like some people, they're good, but you're like, I just don't like you. Yeah.
It's important for me to get to know people and really invest in relationships I'm going to work with over the long haul.
What have you changed your mind on in the last 12 months?
How to win a presidential election.
Which VC would you swap portfolios with most?
I'm not trading, Harry. I like my team. I like our chance at a championship. I really wouldn't trade our portfolio.
Pat Grady swapped his for someone.
Well, I hope they enjoy the trade.
Okay, what concerns you most today?
Misinformation, autocratic regimes, threats to democracy. Those are probably the
What do you know now that you wish you'd known when you joined CapitalG?
I wish I knew just how important getting the really big things right would be. Venture is a business of, 80-20 outsized returns. So you have to make a few big decisions, bold bets right. And I wish I knew to really focus all of the small activities, because you have to do a lot of work and a lot of small activities sort of along the way that build into those big bets that you step up to at the right time. But I wish I really knew the power law and how strongly it existed, and to sort of stay focused on that and stay focused and prioritize my time accordingly.
How many truly important decisions do you make a year?
6 to 8.
Wow, that's
and
interesting.
then a lot of small ones along the way, but probably 6 to 8.
That's more than most people say. Like most are like 1 to 2. I don't know if it's like a venturism.
What do they do with the rest of their time, Harry? I'm just kidding.
I think they're doing 2 investments a year, and so they're just thinking of like net new. Final one for you, Laela. What question, you've done shows before, you've been on other shows. What question are you not asked that you should be asked?
I think venture is a lot more of a people business than maybe others do. A lot more about the insights you have about leaders. What's different about them? What's unique about them? What would make people want to follow them?
Do you not think they're relatively common across all? They may show themselves in different ways, but a good answer is one where you can take the alternative side. And so if I ask you that question, you say incredible ambition, incredible vision. I can't take the opposite side of any of these. Yeah,
so I would argue that it is more actually the outlier point that we talked about earlier. So I think most of the exceptional leaders that I've worked with, they don't all have the same characteristics, but they have something that is incredibly important to followership that will allow followership to happen. So followership is the consistent outcome, but what and how they get exceptional people to follow them differs wildly across company or across leaders.
To what extent is followership tied to success? success hides all ills. Bluntly, I have so many friends at certain companies now, and the companies are just freaking flying. And every 3 months, it's like, I'm so much richer than I was before. I'm so much richer because there's new rounds, new rounds, new rounds. Is it followership of leader or alignment to success, which is addictive?
Well, I think if you have the very best companies, you do need both. But I would argue that sustained durable growth, if you can't recruit world-class talent, is very, very hard to sustain that. To be like, and I would say,
I guess the interesting one is who can go in a shit period and have followership.
Who can go in as what? Say that again.
Who can have a really shit period and have intense followership? That's
completely.
The question.
And that is where I think you need, not all leaders have that. I think some leaders have followership that their outlier characteristics require success as an and some have attributes as a leader that people will stick with them through the hard times as well. And those tend to be, you'll look at those companies that have really strong culture. There's a vision that is even more ambitious, that's harder to achieve. And there's an expectation among those following that there will be hard and dark periods. And then I think others, you see flee ship as soon as things start getting hard because they were following a leader for a certain attribute that if they don't see it translating into success, they're out.
Laela, listen, I'm sorry for my prying questions. I hope that they weren't too prying, but thank you so much for joining me today.
Harry, it's always a pleasure to talk to you, and I love your questions and look forward to catching up over a non-recorded and recorded session again soon to dig in even more.